Hi there. If you like global macroeconomics, and I hope you'll be interested in a couple of charts I want to show you that relate to the scale of government debt of some key countries and the amount of interest they pay on that debt. Let's go to our first chart, and this shows the level of public sector debt held by, for example, nationalised industries and governments. In the Euro area, there are 19 countries there, in the United States and in Japan. It's clear, isn't it, from the chart that since the start of the crisis, which was essentially the last quarter of 2007, the scale of public sector debt has mushroomed. It's gone up from 65% in the Euro area to over 90% of their GDP, in the United States from 80% to 128%. And in Japan, of course, which is always at a higher level of government debt, 175% to 200% of their national output. So we've seen a significant step change in the scale of public sector debt, including government debt. Has that led to interest payments going up? Well, in a sense, yes. Governments, of course, if they have higher debts, they have to pay more in interest. But the level of interest payments as a share of their GDP has actually gone down since the start of the crisis. One of the interesting issues at the moment. In the Euro area, 2.5% approximately of their GDP is spent on paying the interest on debt. It's slightly higher in the States, albeit lower than it was in 2007. Japan, more or less the same. It's just under 2% of the national output. So here's the question a lot of people ask: how can it be the case that if the scale of government debt has gone up, as we saw in our first chart, that the level of interest payments as a share of GDP has gone down? A little bit of a quandary. Well, part of the answer is that the average interest rate, or the yield on the bonds that governments issue, have fallen sharply. So in many countries, including the United States, including Japan, including countries such as Germany and the UK, the yield on, for example, the government borrowing money for 10 years is now, between 0 and 2%. So the big fall in interest rates since 2007 helps explain this second chart. Monetary policy interest rates set by central banks have been exceptionally low since the autumn of 2008. As you can see, they've been low in Japan for the best part of 20 years. But as the onset of the crisis happened in 2008, central banks were rushing to cut interest rates. The Euro area did so eventually. Indeed, in 2016, quite a few policy interest rates in the Eurozone countries were negative in an attempt to stimulate their economies. We expect interest rates in the USA to start going up in the next year or so, perhaps as high as 2%. And if the yield on government bonds starts to rise substantially, that is going to add to the cost of servicing any extra debts the US government decides to take on board. Interest rates in the Euro area, the single currency bloc, remain extremely low, but that hides an interesting feature. So the German government can essentially borrow money for 10, 15, 20 years at a negative real interest rate, whereas countries such as Italy and Spain and Portugal, and in particular Greece, of course, if they want to borrow money for 5-10 years, they're paying much higher interest rates, 5-10% on bonds. So the cost of borrowing is much higher for those countries. These things are worth keeping a tidy eye on during 2017. Is fiscal austerity coming to an end? We'll see.